Part 1. Expanded. Global Market Overview and Record Highs 61.1 Introduction. A market at a turning point. The global financial markets entered April 2026 in a state of remarkable momentum, with U.S. equities continuing a strong upward trajectory that has surprised both institutional investors and retail participants. Major indices, including the S&P 500 and Nasdaq Composite, recently achieved multiple record-breaking closes within a compressed time frame, highlighting a powerful wave of bullish sentiment. However, markets rarely move in a straight line. Following a sequence of historic highs, early trading on April 23, 2026, reflected a modest but meaningful pullback, while the declines, ranging between 0.1% and 0.4%, may appear minor on the surface. They signal the beginning of a potential transition phase, where investors reassess risk, valuation, and macroeconomic realities. This report begins by examining the broader context behind these record highs and the immediate catalysts driving the current pullback. Point 1.2. Record-breaking momentum. Understanding the rally in the 6 trading sessions leading up to April 23, both the S&P 500 and Nasdaq Composite recorded 4 separate all-time closing highs. The Nasdaq went even further, achieving 5 intraday record peaks within the same period. Such a rapid clustering of record highs is not a random occurrence. It reflects several converging forces: A. Liquidity and monetary stability. Despite previous concerns about aggressive tightening cycles, financial conditions in early 2026 remained relatively supportive. Investors interpreted central bank policy as stable enough to sustain economic expansion without triggering a recession. B. Risk appetite resurgence. Investor appetite for risk assets surged, fueled by optimism surrounding easing geopolitical tensions, particularly a temporary ceasefire involving Iran. This environment encouraged capital flows into equities, cryptocurrencies, and other high-beta assets. C. Technology sector leadership. The rally was heavily concentrated in technology stocks, particularly large-cap companies, often referred to as the Magnificent Seven. These firms continue to dominate index performance due to their scale, innovation pipelines, and earnings resilience. D. Institutional participation. Large institutional investors, including hedge funds and pension funds, played a crucial role in sustaining upward momentum. Their allocation strategies increasingly favored equities over fixed income instruments, especially as bond yields showed signs of stabilizing. 1.3. The pullback, a healthy correction or warning signal. On April 23, markets opened slightly lower. Dow Jones Industrial Average 0.4%, Nasdaq Composite 0.2%, S&P 500 0.1% at face value. These declines may seem insignificant. However, within the broader context of record highs, they carry deeper implications. Key interpretation. This type of pullback is often categorized as a consolidation phase, when a period where markets digest recent gains before determining their next directional move. Historically, such phases can lead to continued upward trends, bullish continuation, sideways movement, range-bound consolidation, sharper corrections, if triggered by external shocks. 4. The role of geopolitical tensions. 8. One of the most immediate catalysts for the market's hesitation is the renewed tension in the Middle East, particularly involving the Strait of Hormuz, a critical choke point through which a significant portion of the world's oil supply passes. Recent developments include seizure of vessels by Iranian naval forces, escalating rhetoric and military warnings from the United States rising, fears of supply chain disruption in global energy markets. These events pushed oil prices sharply higher. U.S. crude, WTI, 94 per barrel. Brent crude, $103 per barrel. Why this matters? Oil price increases have a cascading effect on the global economy. Increase inflationary pressure, raise transportation and production costs, reduce corporate profit margins, potentially trigger tighter monetary policy for equity markets. This introduces uncertainty, one of the primary drivers of volatility. 1.5. Market internals. What lies beneath the surface even during record highs? Not all parts of the market move uniformly. Beneath the surface, several divergences were already forming. Weakness in select mega-cap stocks despite leading the rally. Some major technology firms began to show signs of exhaustion, with early declines in key names such as Microsoft and Tesla. Earnings-driven volatility corporate earnings reports introduced stock-specific shocks. ServiceNow declined sharply due to weaker subscription growth. IBM fell despite beating expectations. This divergence indicates that investors are becoming more selective, focusing less on broad market momentum and more on individual company performance. 1.6. Cross-asset signals the broader financial ecosystem, provides additional clues about market sentiment. Bonds. The 10-year Treasury yield edged slightly lower, LAR 4.29%, suggesting mild demand for safer assets. Commodities. Gold remained relatively stable, indicating no immediate panic but persistent caution. Cryptocurrency Bitcoin hovered near $80,000, reflecting strong speculative interest but also slight pullback behavior. Currency markets. The US dollar strengthened marginally, often a sign of risk-off sentiment in global markets. 1.7. Conclusion. A fragile balance. The market currently stands at a delicate intersection of optimism and risk. On one side, strong earnings momentum, high investor confidence, technological innovation. On the other, rising geopolitical tensions, elevated oil prices. Valuation concerns. The slight dip observed on April 23 is not, in itself, a cause for alarm. However, it serves as an early indicator that the market may be transitioning into a more complex phase, one where gains are harder to achieve and risks are more pronounced. Storm Part 2. Macroeconomic forces driving the market. 52.1 Introduction. The invisible hand behind market moves. While daily headlines often focus on stock price movements, the true drivers of long-term market direction lie beneath the surface. In macroeconomic forces, these include inflation trends, interest rate policies, economic growth, and global liquidity conditions. Understanding these forces is essential because they influence corporate earnings, investor behavior, asset valuations, risk appetite across global markets. In this section, we analyze the key macroeconomic variables shaping the current environment in 2026 and their impact on equities, bonds, and alternative assets. 2.2 Inflation. The market's primary concern, inflation, remains one of the most critical variables influencing financial markets. After the high inflation period earlier in the decade, global economies have been working towards stabilization. Current inflation landscape. Inflation in 2026 has moderated compared to peak levels, but it has not fully returned to central bank targets. This creates a gray zone where inflation is not high enough to trigger panic, but not low enough to justify aggressive rate cuts. Why inflation matters. Inflation directly impacts markets in several ways. Consumer purchasing power. Higher prices reduce disposable income, which can slow economic growth. B. Corporate margins. Rising input costs, energy, labor, materials, can compress profit margins. C. Interest rate policy. Central banks adjust interest rates based on inflation trends, which in turn affects borrowing costs and asset prices. 2. 3. Interest rates and central bank policy. 5. At the center of global financial markets is the policy direction of the Federal Reserve. Current policy stances of April 2026. Interest rates remain relatively elevated compared to pre-2020 levels. The Federal Reserve has adopted a wait-and-see approach. Markets are pricing in potential rate cuts later in the year, but uncertainty remains. Impact on markets. A. Equity valuations. Higher interest rates reduce the present value of future earnings, which disproportionately affects growth stocks, especially those in the tech sector. B. Borrowing costs. Companies face higher costs when issuing debt, which can slow expansion and investment. C. Consumer spending. Higher mortgage and loan rates reduce spending, particularly in housing and durable goods sectors. 2.4 Economic growth. Resilient but uneven economic growth in 2026 has shown surprising resilience, especially in the United States. However, this growth is not evenly distributed across sectors or regions. Key observations. The U.S. economy continues to expand at a moderate pace. Consumer spending remains relatively strong. Labor markets are stable, though cooling slightly. Sector-level divergence. Different sectors are experiencing varying levels of growth. Technology, strong growth driven by innovation and AI adoption. Energy, benefiting from rising oil prices. Consumer discretionary, facing pressure due to higher interest rates. Industrial sector, mixed performance depending on global demand. 2.5. Global liquidity. Fuel for the market. Liquidity refers to the amount of capital available in the financial system. It is a crucial driver of asset prices. Sources of liquidity: central bank balance sheets, institutional investment flows, retail investor participation, global capital movements. Current liquidity conditions. Although central banks have reduced some stimulus measures, liquidity remains sufficient to support markets. This is one of the main reasons equities have continued to rise despite macroeconomic uncertainty. Risk factor: if liquidity tightens significantly, e.g., due to aggressive rate hikes or financial stress, markets could experience sharp corrections. Increased volatility, reduced risk appetite. 2. 6. The bond market signal. The bond market often provides early warnings about economic conditions. Current indicators: the 10-year Treasury yield remains around 4.3%. Yield curve dynamics suggest cautious optimism. Demand for bonds has increased slightly during recent equity pullbacks. Interpretation: bond markets are signaling no immediate recession but increased caution among institutional investors. This divergence between strong equity performance and cautious bond behavior is worth monitoring. 2.7. Currency markets in the U.S. dollar. The strength of the U.S. dollar plays a major role in global financial stability. Current situation: the U.S. dollar index has shown mild strength. Currency markets reflect cautious sentiment rather than panic implications. A stronger dollar makes U.S. exports more expensive, puts pressure on emerging markets, attracts global capital into U.S. assets. 2. 8. Commodities and inflation feedback loop. Commodity markets, especially oil, are tightly linked to macroeconomic conditions. Current trend: oil prices are rising due to geopolitical tensions. Gold remains stable, acting as a hedge feedback mechanism. Rising commodity prices can increase inflation, force central banks to maintain higher interest rates, slow economic growth, impact stock market performance. 2. 9. The crypto factor, a new macro indicator. Bitcoin has increasingly become a macro-sensitive asset. Current position trading near $80. Zeros and driven by institutional adoption and risk appetite. What it signals: Bitcoin's behavior suggests strong speculative demand, confidence in alternative asset, sensitivity to global liquidity and interest rate expectations. 2.10. In key takeaways: the macroeconomic environment in 2026 can be summarized as stable but uncertain growth, positive but inflation sensitive, supportive of equities but fragile under pressure. Markets are currently balancing optimism about growth, concern about inflation and geopolitics. 3. 1. Introduction. Why geopolitics still moves markets. Financial markets are often driven by data, earnings, inflation, and interest rates. But geopolitics remains one of the most powerful and unpredictable forces affecting global stability. In April 2026, rising tensions between the United States and Iran have reintroduced a familiar but dangerous variable into the market equation: energy supply disruption risk. At the center of this situation lies one of the most critical choke points in the global economy: the Strait of Hormuz. 3. 2. The strategic importance of the Strait of Hormuz. The Strait of Hormuz is not just another waterway. It is the artery of global oil supply. Key facts: roughly 20% of the world's oil supply passes through this narrow passage. It connects the Persian Gulf to global markets. Its major oil exporters depend on it: Saudi Arabia, UAE, Iraq, Kuwait. Why markets react immediately? Any disruption in this region creates a chain reaction. Supply fears push oil prices higher. Inflation expectations rise globally. Central banks become more cautious. Equity markets experience volatility. Even minor incidents in this region can trigger major price swings. 3.3 Recent developments driving market anxiety. The current market reaction stems from a series of escalating events. Iranian naval forces reportedly seized vessels in the region. Military warnings increased from the United States. Strong statements about protecting maritime security. These developments may not yet constitute a full-scale conflict, but markets don't wait for certainty. They react to risk probability, not just outcomes. 3.4 Oil prices. The first and fastest reaction. 5. The most immediate impact of geopolitical tension is seen in oil markets. Current price movement. WTI crude oil, $94 per barrel. Brent crude oil, 103 $103 per barrel. These increases may appear moderate, but in financial markets, direction matters more than magnitude. Why rising oil prices matter. Inflation shock. Higher energy prices increase costs across the economy. Transportation, manufacturing, consumer goods. B. Profit margin pressure. Companies face higher input costs, which can reduce earnings. C. Policy impact. Central banks may delay interest rate cuts if inflation rises again. 3.5 Historical context. Markets and oil shocks. To understand today's situation, it's useful to look at history. Major oil shock events. 1973 oil crisis triggered global recession. 1990 Gulf War, short-term oil spike. Market volatility. 2008 oil surge contributed to economic instability. 2022 Russia-Ukraine conflict, energy-driven inflation spike. Key pattern. Markets tend to react sharply at the onset of geopolitical tension. Stabilize if supply disruption is avoided. Crash only if prolonged disruption occurs. This pattern suggests that duration and severity matter more than the initial event. 3.6 Impact on stock markets. Geopolitical tension does not affect all stocks equally. Negative impact sectors. Airlines, higher fuel costs. Transportation and logistics. Consumer discretionary. Positive impact sectors. Energy companies, higher oil prices, higher profits. Defense stocks. Commodity producers. Current market behavior. The recent dip in major indices like the S&P 500, Nasdaq, composite reflects broad uncertainty, not panic. 3.7 Safe haven assets. Where money moves in uncertainty during geopolitical stress, investors often shift capital into safer assets. Typical safe havens. Gold US, Treasury bonds US. Dollar current signals. Gold prices are stable, not surging yet. Bond yields slightly declining. Dollar strengthening modestly. Interpretation. Markets are cautious, but not fearful. 3.8 The psychological factor. Fear versus reality. Markets are not driven purely by facts. They are driven by expectations and psychology. Key insight. Markets price in possibility, not just reality, even if no actual disruption occurs. Fear alone can drive volatility. Traders adjust positions preemptively. Algorithms amplify market reactions. This creates short-term swings that may not reflect long-term fundamentals. 3.9 Best case versus worst case scenarios. Down. Best case scenario. Tensions de-escalate. Oil prices stabilize or decline. Markets resume upward trend. Down. Moderate scenario. Continued tension without conflict. Oil remains elevated. Markets trade sideways, volatile but stable. Anti-worst case scenario. Supply disruption in the Strait of Hormuz. Oil spikes above $120 plus. Global inflation surge sharp. Stock market correction. 3.10 Key takeaways. Geopolitical risk is unpredictable but powerful. Oil prices act as the transmission channel to the global economy. Current market reaction is cautious, not panicked. The situation's evolution will determine whether this is a temporary shock or major turning point.